Hello there. As a professor of taxation, I've seen it time and time again. Business owners, students, you name it, getting completely tangled up in the rules around sales tax. But here's the thing, it really doesn't need to be that complicated. So today, we're going to demystify the Canadian Goods and Services Tax, the GST, and its cousin, the Harmonized Sales Tax, or HST. We'll take it step by step so you can walk away feeling confident about how it all works. So here's our game plan for today. We're going to start with a big picture look at how sales tax works across Canada. Then we'll dive right into the mechanics of how the tax is collected. After that, we'll get into the nitty-gritty of what every business owner needs to know. And we'll finish up with a couple of really practical examples that could save you a lot of time and money. Sound good? Let's jump in. All right, first things first, you have to understand that Canada does not have one single national sales tax system. It's more like a patchwork quilt. The federal government has its GST, but every province gets to decide how they want to handle their piece of the puzzle. So let's take a look at what that quilt actually looks like. This table really lays it all out for you. You've got a few different flavors of sales tax depending on where you are. If you're in Alberta, life is simple. It's just that 5% federal GST. Then you have provinces like BC, where they tack on their own provincial sales tax, or PST, on top of the GST. And finally, you have the HST provinces, like Ontario and the Atlantic provinces, where they've combined the federal and provincial taxes into one single rate. Knowing which system you're operating in is absolutely fundamental. So, how does this tax actually get collected? This is probably the most important concept we'll cover today. GST and HST are what we call a value-added tax. This is totally different from a simple retail sales tax like PST, which is only paid once by the final customer. So why do it this way? Well, it makes the system incredibly robust. By collecting a little bit of tax at each stage of the supply chain, the government smooths out its revenue and makes it much, much harder to evade the tax. Okay, so let's put a formal definition to that. A value-added tax is charged on the value added at each step in the supply chain. What this really means is that businesses are constantly charging GST to and paying GST to other businesses along the way. It's not just a transaction between a store and a customer. Let's see what that looks like in action. Let's trace the journey of a simple product. You've got a manufacturer who makes something and sells it to a wholesaler. That wholesaler then turns around and sells it to a retailer. And finally, the retailer sells it to you, the end customer. In a value-added system, GST is part of the transaction at every single one of those handoffs. And this table perfectly illustrates the genius of the system, what we call the invoice credit method. Take a look. The manufacturer sells for $10,000, collects $500 in GST, and sends that right to the government. Simple enough. Now look at the wholesaler. They collect $1,250 from the retailer, but, and here's the magic, they get to claim a credit for the $500 they already paid to the manufacturer. So they only send the difference, $750 to the government. The retailer does the exact same thing. And what's the end result? The total tax sent to the government is $2,500, which is exactly 5% of the final sale price. The system basically polices itself because every business in the chain is motivated to claim their credit. Okay, so now we understand how the tax flows. But the next huge question is, what exactly gets taxed? Because GST and HST don't apply to everything. And for any business, understanding the difference between a taxable supply and an exempt supply is absolutely critical. Here is the absolute core difference. If you're in the business of providing taxable supplies, you charge GST/HST to your customers. But you also get to recover the GST/HST you paid on your own business expenses. These are called input tax credits, or ITCs. Think of them as a refund from the government for the tax you paid to run your business. On the flip side, if you provide exempt supplies, you do not charge GST/HST. But and this is a big but, you also lose the right to claim any ITCs. That tax you pay on your expenses becomes a real hard cost to your business. Now, just to add one more layer of fun, that taxable category is actually split in two. You've got your standard, fully taxable supplies where you charge the regular rate, but then you have this special category called zero-rated supplies. Here, the tax rate is literally 0%. The customer pays nothing. But because it's still technically considered a taxable supply, the business gets to claim full input tax credits on its expenses. This is a huge deal. It means those goods and services are truly tax-free from start to finish. Let's make this real. A meal at a restaurant, a new shirt, your lawyer's bill, those are all fully taxable. Basic groceries like milk and bread or a prescription from the pharmacy, those are 0 rated. You don't pay GST at the till, but the grocery store still gets to claim ITCs on all its costs. And finally, things like a visit to the dentist or your monthly rent are exempt. Your landlord doesn't charge you GST, but they also can't claim ITCs on the cost of a new roof. So let's say you're starting a business and you're providing taxable supplies. You might be wondering, do I have to start collecting GST for my very first sale? Well, the answer is not necessarily. The government has a really important break for small businesses, and you need to know these rules. This is the magic number. You need to burn this into your memory. $30,000. If your business makes $30,000 or less in taxable sales in a year, you're considered a small supplier, and you don't have to register for GST/HST. Now, you can register voluntarily, and you might want to if you want to start claiming those valuable ITCs on your startup costs. So how do you know when you've crossed that $30,000 line? Well, it's not as simple as just checking your books on December 31st. You have to monitor your revenue constantly, using 2 different tests that the Canada Revenue Agency has set up. Let's walk through the first test. You're always looking at your cumulative sales over the last 4 quarters. In this example, ABC Company is doing fine in Q1 and Q2. But look what happens in Q3. They have a great quarter, and their cumulative sales hit $38,000. They've crossed the threshold. So what happens now? The rule is they stop being a small supplier at the end of the month after the quarter they cross the limit. So they crossed in the quarter ending March 31st. 1 month after that is April 30th. That means on May 1st, they have to be ready to start charging GST. Now, the second test is kind of like the express lane. It's designed to catch businesses that grow really, really fast. If you manage to make more than $30,000 in taxable sales in any single calendar quarter, you stop being a small supplier immediately. There's no 1-month grace period. And this is the part that is so critical to understand. With a single quarter test, the moment you make that one sale that tips your revenue for the quarter over 30 grand, you must charge GST on that exact sale and on every single sale after that. This means you have to be tracking your numbers very closely because it can catch you by surprise. Okay, so you're registered. Now comes the part everyone loves, the bookkeeping. Tracking all the GST you've collected and every single ITC from every receipt, it can be a lot. But luckily, for smaller businesses, the government has created a shortcut to make life a little easier. So, how do you simplify things? The answer, for many, is something called the quick method. It's an alternative way to figure out how much tax you owe, and it's available for businesses with sales under $400,000 a year. And trust me, it can save you from a mountain of paperwork. Here's how it works. You still charge your customers the full GST or HST, but when it's time to pay the government, you don't track the ITCs on your day-to-day operating expenses like rent or phone bills. Instead, you just follow this simple 5-step recipe. You use a special lower rate, you get a small credit, and then you only have to track ITCs on your big-ticket capital purchases. Let's see this in action. We've got a retail store in BC with $125,000 in sales. First, we add the 5% GST to get their total collections. Then we apply the special quick method rate for their industry, 1.8%, which gives us $2,363. From that, we subtract a $300 credit. And finally, they subtract the $1,000 ITC from that new piece of equipment they bought. Their final amount owing is just $1,063. See? So much easier than adding up dozens of tiny receipts. All right, let's move on to our final topic, and this one is incredibly practical because it affects thousands of Canadians every year. It's the GST/HST new housing rebate. You see, when you buy a brand new home from a builder, GST or HST is part of the price. But the government has a rebate to help make that purchase a little more affordable. Now, what's really clever here is how the rebate is designed. It isn't just a flat amount for every new home. It's targeted. It's meant to help people buying homes on the more affordable end of the scale. As you can see, you get the full rebate on homes priced up to $350,000. Then it starts to gradually shrink, and once the price hits $450,000, the rebate disappears completely. It's a really targeted piece of policy. So let's actually crunch the numbers. Let's say you buy a new home for $385,000. You're right in that phase-out zone. The formula might look a little intimidating, but it's pretty straightforward. You take A, the maximum possible rebate, and multiply it by a fraction. That fraction is just a way of measuring how far your home's price is from that $450,000 ceiling. So in this case, we plug in the numbers, Do the quick math, and we land on a final rebate of $4,095. It's a perfect final example of how understanding these rules can have a very real and very positive impact on your finances.